So we're very pleased to have David G. Dietze here with us today. David Dietze is Managing Principal and Senior Portfolio Strategist of PPAC Private Wealth Management, the wealth management division of PPAC Gladstone Bank. In 1993, he founded Point View Wealth Management, which became PPAC Private Wealth Management upon its acquisition by PPAC Gladstone Bank in 2019. Before founding Point View Wealth Management, Mr. Dietze was of counsel at Crowell and Mooring, and previous to that, he was an associate at White and Case. Mr. Dietze graduated with a law degree from the University of Chicago Law School and a bachelor's in economics from Dartmouth College. He has been a member of the Dartmouth Lawyers Association for over 35 years. Thank you for joining us today, Mr. Dietze.
Hey, thank you so much. It is a distinct honor to appear here. True confessions, my sister was a 1979 graduate of Brown. She's a proud alum of your school. I happen to be a Dartmouth guy, but happy to appear here. So I do have a presentation which I would like to go through, and then really delighted to take some Q&A here. So I'm going to share my screen here. Hopefully I can do that, right? Does that work? Do you got the screen there? So there's my cover page. Basically, let me just go to the next page here. Just give you half a second here on what we do. You had a great outline of my background. I am part of PPAC Private Wealth Management. Delighted and proud to be part of them. We consolidated with them in 2019. And, we're into the investing and so forth. How do we differ? We do adhere to the highest fiduciary standards. We always want to make sure to put the client first in everything we do. We are part of a much larger organization, a PPAC Bank, which is based in Bedminster, New Jersey. Altogether, we manage over $11 billion. We focus on investment management, but have a big practice in terms of the financial planning, which is very important to private clients. We manage for tax efficiency, and we tend to use stocks as opposed to funds. We have the maximum in terms of tax efficiency, transparency, and keep those costs down. Now I'm going to go right into my presentation here. So, what is value investing? Value investing is trying to get the most profits from a company with the least investment outlay. A value investor carefully analyzes for each dollar laid out, what's the most dollars of profit, cash flow, sales, free cash flow that you'll be entitled to. Ben Graham, the kind of dean of value investing, likened this style of investing to buying your groceries. You know how on the shelves in the aisle, they have those little signs that indicate for each brand or size of a product, how much you're paying per ounce or other unit of quantity. Value shoppers look for the most units at the lowest cost, ignoring that pretty label or that new and improved puffery. Similarly, a value investor is skeptical of the little size container of the national brand, preferring to head to Costco or similar. Get that huge box of the house brand, realizing that on a per unit basis, the investor is paying substantially less. A key attribute of value investors is to prefer one in the hand versus two in the bush. While two in the bush might be nice, value investors keep a healthy degree of skepticism as to whether the two in the bush does in fact materialize. Stories of eventual profits in largesse are looked at with skepticism. Well, why is that? The future is always uncertain. So that's one reason that value investors prefer the one in the bush. The second is buying into the two in the bush store usually requires paying up, paying more, and if the promise of growth doesn't materialize, risking the loss of principal. Value investors like troubled situations. Many investors tend to overreact to bad news, even though most bad situations will indeed pass. And so you can take advantage of that knee-jerk pessimism to get otherwise solid businesses on the cheap. Examples of bad news that can cause that overreaction are strikes, litigation, personnel changes, problems happening to other companies in the same sector that may not have a direct bearing on the company you're trying to analyze. You can be more confident in buying on the dip if that reason for the dip will not last forever. Value investors look for a margin of safety. If you're trying to buy a company for less than the market, if it's a lot less than the market and things don't work out great, you may still end up with a company cheaper than that market. So if the overall market trades at 20 times earnings and your prospective investment's at 10, even if earnings don't materialize as well as you'd hoped, you may still have a company trading at 15 times less than the overall market. Next slide. So countless studies have shown that indeed value investing does work, that buying stocks at a discount provides superior performance relative to buying stocks at a premium. The phenomenon has been observed both in this country and overseas, and has been documented to exist going back 100 years or more. Of course, no strategy works all the time. Value stocks actually have not been great performers in the last decade, although that record is starting to improve recently. And indeed, so far this year, value stocks have way outperformed. Just as importantly, I think value investing just makes sense. No matter what you're buying, whether it's stock, real estate, art, you name it, your expected returns must improve the less you pay up front. As that supermarket slogan exhorts, why pay more? The other very intuitive way of looking at the situation is to examine the chart of historical prices of an investment. You will find typically a series of squiggles with the price moving up and down. Aren't you always better off buying that investment at the bottom of those squiggles as opposed to the tops? I would admit that I believe that any investment style can work if followed religiously over the long haul. Just owning stocks will, based on that historical record and common sense, benefit you. In my experience, there's only one way you can really do yourself a disservice. That is to chase price performance. There's really no logic in being more bullish on investment if you have to pay up for it to buy it, and more bearish if you can pay less. A subcategory of the foregoing, which is there's mentioned, is that you don't want to keep switching strategies. That's typically a case of actually chasing price performance. You don't want to start being a value investor because they're working and then start investing in growth stocks when they appear to be working. That also applies to other strategies like small cap versus large cap, international versus domestic, quality versus, I guess, non-quality. So I believe the ultimate tools of the trade for a value investor are numbers and statistics. Adjectives and intuition really don't count. You're looking for profits generated, sales realized, cash flow reported, free cash flow. Then you can compare versus the cash you're spending out. You're not gravitating to simply the best story, buying into the latest concept. What metric is best? I like free cash flow. As the name implies, it's the cash that's being generated from operations that the company can distribute to its owners, the shareholders, because it's not needed to run the business. It's better than earnings because earnings which are just being recorded but are not actually being accompanied by cash coming in are a tad more suspect. And any accounting profits that the company actually must allocate to expenses, let's say maintenance, capital improvements, to keep that business going, and are therefore not available to the shareholders, are also more suspect. Hey, sales is a great metric. Sometimes, due to a business downturn, a business has no profits or free cash flow, but it's still operating. Looking at sales per investment dollar that you lay out to buy into the stock can give you a sense as to the potential value in the business if business picks up or the company is able to cut costs. Earnings depend on how a business chooses to spend its revenues, and thus looking at sales versus just earnings helps to remove that factor. If earnings are too good relative to revenues, perhaps the margins are not sustainable, and the business is overly cutting costs now that will have to be paid out later. And of course, if margins are too small, perhaps there's an opportunity to increase profitability by reducing costs. It's wise to keep in mind the accounting protocols for the industry involved. Consumer products companies advertise heavily. The expenditures are immediately subtracted from profits, but unlike some expenditures, should provide benefits and goodwill in succeeding years. Similarly, Some R&D costs for tech and healthcare companies are deducted immediately from profits, but will have benefits down the road. An issue that frequently comes up when looking at the various metrics is, do you look at last year's numbers, the current year's, or projections for next year? Investors in stocks look forward, but as the future is always uncertain, you want to look at last year's and the current year too. Finally, the stability and risk around the generation of the numbers must be kept in mind. How much debt is being used to generate the profits? What's the size of the company and the length of time in business? What is their market share? So, what's the ideal investment for a value investor? Well, like most things, no investment is perfect, and everything involves trade-offs. Numbers are always on a continuum, and there are many shades of gray. Plentiful earnings are a must relative to your investment outlay. However, if the PE metric is the same for two different companies, the company with the higher market share, a lower debt level, less cyclicality in its operations, has a better chance to grow those earnings, may be more attractive. The problem, of course, is the PE levels of two different companies are never identical. So the question can come down to how much less in the way of earnings will you accept per dollar of investment outlay to get that lower debt level, that lesser cyclicality, that higher market share, those better growth prospects. To make it more complicated, some of the flaws in your proposed investment may actually be opportunities. You know, the company with the lower market share may be able to increase its market share, while the company with the big high market share may have less chance to grow it and perhaps may be targeted by regulators for being a monopoly. The company with the extra debt may be able to pay it down, while the company with the smaller debt may go on a spending and borrowing spree. You know, the quality of management is frequently cited as an issue. Ben Graham, that dean of value investors we mentioned before, always ignored a management's reputation. He reasoned that if management was so good, it would be already reflected in the numbers. So to pay even more for the stellar reputation was double counting, double overpaying. And if the numbers weren't that good, how deserving is that management's reputation? Another reason for not paying up for the so-called celebrity CEO is that that situation can change fast. I tell my clients that the only thing worse than investing in a company with poor management is to pay up for a company with a star CEO, only to see that CEO depart after you've made your investment. Special value situations. So, you know, there are many places to look for value. They don't all just involve setting up a screen for low PE stocks. Consolidated or conglomerate companies can provide opportunities. They may not appear on a conventional screen for value investments, since the parent company's earnings may not fully reflect the cash flows of the valuable subsidiaries. Or a company has several businesses within it. Its overall appeal is limited because investors want to steer clear of one of those businesses. Or each of the component businesses may have better prospects if they had their own stock and independence, thus motivating better the managements of each of the components. Sometimes investors steer clear of a conglomerate because industry experts can understand one of the components, the one in their industry of expertise, but are uncomfortable analyzing the components outside their area of expertise. Companies may, under those circumstances, be motivated to unlock that value by separating the businesses. Savvy value investors can anticipate and then buy the conglomerate in advance. The trick is to value each of the components as if it were a standalone, add them up, and see how that compares to the current stock price. I also like discounted closed-end funds. Closed-end funds are a bit of a hybrid between an open-end fund and an exchange trade fund, aka ETF. Like both of them, they pool the money of investors and have an investment objective. They are virtually always actively managed. Like ETFs, they trade all day on the stock exchange. However, the funds themselves are closed, meaning for an investor to get in or to get out, it must find a willing party to trade with on the exchange. Like a publicly traded company, that closed-end fund has no responsibility to make a market in its shares, nor redeem its shares or issue new ones. Your opportunity can come when the market price of the shares becomes significantly lower than the net asset value of the fund's holdings. Value investors can jump in then and profit from growth in the value of the portfolio or closing the discount. So what happens if the discount never closes? You're still better off because the discount represents the equivalent of an interest-free, non-callable loan for part of your investment. What are the caveats? Well, that discount could widen. That's why you look for a historically wide discount in the first place. Closed-end funds have relatively small market caps, so liquidity can be an issue, but if you're a small investor, so what? The holdings may have significant embedded unrealized capital gains. If those positions are turned over while you hold the shares and the gains are effectively realized, you could have unwanted capital gains attributed to you. A problem if you're holding in a taxable account, so consider your IRA. The funds may have relatively high management fees, which nevertheless can be justified if the discount is wide enough. And finally, many closed ends, particularly fixed income ones, are leveraged. Leverage can magnify gains, but can make the fund more volatile and could hurt returns in a rising rate environment. So astute value investors will always be on the alert for a flash sale, analogous to a clearance day at your local store. On a regular basis, markets sell off. 5% sales occur regularly. 10% sales, called corrections, happen annually or more often, while 20% sell-offs, known as bear markets, happen at least every 5 years. Warren Buffett has said stock investors should anticipate a possible pullback of 50% in the market several times during one's investment career. So the advantage of the market sell-off for that value investor is that your favorite value ideas are likely to become significantly cheaper. Since the whole market is selling off, you have confidence that the cheapening shares of your target are not reflecting a problem within that company or anything intrinsic to it. The market, has never failed to come back after a sell-off, although the amount of time it can take is uncertain. And of course, there's no guarantee on the future. However, a significant market sell-off will not escape the notice of politicians who will try to take whatever policy actions they can to right that ship. Sector sell-offs are similar. You have the comfort of knowing that your favorite value investment within that sector is unlikely to be down because of its own failing, but because all the companies in the same endeavor are also down. Companies can go bankrupt, but sectors don't, and historically rebound, although again, the timing is never perfectly clear. Examples of whole sectors doing unusually poorly include the tech wreck of the early 2000s, the finance sector during the subprime crisis, and the energy sector during the pandemic, when crude oil prices went negative. Countries can go down too. Again, if your favorite value stock is based in that country, you have some assurance that its descent is not due to a company-specific issue. So that may give you the confidence and opportunity to take advantage of a bargain, not due to special problems affecting that company. So regularly scan the country indexes to see what the laggardations are, as that may give you an opportunity to buy at a value price investment within the company. A great recent example, the legendary Charlie Munger backed up the truck on China-based Alibaba in Q3 of last year, apparently believing that the sell-off in the Chinese market, including Alibaba, provided a value investment opportunity. I believe my last slide here is on popular value strategies. They're really well worth considering and or studying for additional ideas. Perhaps the most famous value strategy is the dogs of the Dow. That was popularized by Michael Higgins in the early 1990s. And this strategy calls for selecting the 10 highest yielding Dow components at the start of the year, investing in them, and then rinse and repeat at the start of each succeeding year. The value logic behind the strategy is that high yielders represent better value for your money, with dividends being a type of proxy for the cash flows being generated by the businesses. This strategy has outperformed, but not every year, and indeed has underperformed for multi-year periods. So, even if you're not prepared to dive into the entire dog of the Dow strategy, I do think it's worth periodically perusing the current dogs, meaning those in the top 10 high yielders of the Dow at whatever time of the year you're looking, to see if any merit further research as a possible value investment. Critics, of course, point out the dogs are typically not in that category because they raise the dividend, but because the stock has declined, leaving the dividend as a higher percentage of the stock price. However, Dow stocks tend to be larger, well-seasoned, and thus typically have the resources and skills to address whatever issue is dragging the stock down and ultimately have investors award it a higher stock price. Of course, turning over your stocks at the end of each year may not be tax efficient. Also, a high dividend can be a proxy for an undervalued company, but not necessarily so. So you want to use the dogs as an initial screen, not as a definitive buy list. That high dividend may not be covered by the free cash flow or earnings. Hey, spin-offs can offer investment opportunities too. Companies typically spin off divisions or subsidiaries if they become a distraction to the company. Those divisions or subsidiaries have poorly perceived growth opportunities, or if it's believed that a streamlined company will garner a higher stock price. So investors who own the stock, jettisoning the spinoff, may immediately sell the spun-off entity, thinking, well, the spinoff is not consistent with their investment objectives, and or thinking that, look, if the parent didn't want it and spun it off, why should they want it? So that can depress the stock price, and value investors can swoop in, thinking that at a low enough price, anything can be profitable. If investors often miscalculate on what is or is not going to grow, so too can managements of those parent companies. And to the extent investors are selling the spun-off companies because they don't fit in with their portfolio strategy, I like that as a potential opportunity. Why? Because they are depressing the prices due to their sales, and the selling is not really due to the fundamental factors affecting that spun-off company, but simply due to extrinsic factors involving portfolio management. So with that, I would be delighted to take questions. Should I stop the share screening? What do you advise there?
Yeah, I think so. That would be great. Thanks. Great.
Awesome.
Thank you so much for that presentation. It was really phenomenal and very educational and very helpful. And yeah, we'll get started with the questions. So our first question is, how has your law background helped you in investing?
Certainly, people who do law do have the patience to sit down and go through a lot of written material and perhaps think as logically as the next person. I tell people what the main difference is and why I prefer the investments versus the law is. In the law, you are about 2 inches wide and 10,000 miles deep. You become an expert on, what law should control the contract. But the problem is often you have no understanding as to what the contract is trying to do, who the winner is, who the loser is. You just get very narrow in your expertise. The beauty I find of the law is that you're about 2 inches deep, but 10,000 miles wide. You need to know something about what's going on in Russia and Ukraine. You need to know something about commodity prices. You need to know something about antitrust law and how it may affect big tech. You need to know something about politics and how the composition of our government might change at the next elections in November, the midterms. But you don't need to necessarily be an expert in constitutional law. You just need to know how the change in the politics might affect policies that could affect your investments or your investing strategy. So that's why I prefer it, is you have to be conversant on everything, but you don't get so deep into any one topic that you lose the forest for the trees.
Yeah, absolutely. That makes a lot of sense. And are your investments purely US listed, or do you invest in foreign markets as well?
Primarily US, although we do include ADRs, which are American Depository Receipts of overseas investments. I always tell my clients that I think domestic versus international is a bit of a red herring. Where your headquarters are is really a very minimal factor compared with what your business strategy is, what your cash flows are going to look like, what your market share is. I'd like to give the example of BP versus Exxon. So Exxon is based in Dallas, although they recently said they're going to move closer to Houston. But most of their operations are actually outside the United States. While you take BP, formerly known as British Petroleum, most of their assets and resources are located within the United States. So who is the true international company? Would you pay more for Exxon just because its headquarters are in Texas, even though they do most of their business outside the United States, and pay less for BP just because they're in London and that's outside the United States, even though they're doing most of their operations, for example, in Alaska and Ohio and things like that? And so we try and be agnostic, but we'll take advantage of, on behalf of our clients, a situation where you're paying less per dollar of earnings, per dollar of dividends, because it's outside the United States than it is within. Now, the other thing, of course, is I mentioned the closed-end funds. Often, if you want to get exposure, but we really don't have the expertise to analyze smaller companies outside the United States, by tapping into a closed-end fund that specializes in that region, you can get the expertise of a country or geographic area specialist. And to the extent that you're paying less than 100 cents on the dollar for the investments within it, it's win-win. You get some great help and expertise in that area, and you're paying less than you would have to pay for if you bought the components individually.
Yeah, absolutely. And you're discussing some energy companies previously. How are you viewing investing in the energy sector today? Does it look attractive to you?
So I think over the longer term, it does look attractive. And I think a couple reasons. I think the overriding reason is that public opinion and policymaking initiatives have made it to the point where companies are afraid or don't want to continue pursuing fossil fuel development. And of course, investors are the same way. I mean, look at many of the endowments of certainly my alma mater, Harvard and so forth, perhaps Brown. They're steering away from fossil fuel investment. So, whenever investors make a decision on investment for other than fundamental reasons, that can be an opportunity because you can get it cheaper. It's a little bit like the new tobacco, right? At the same time, of course, hopefully, knock on wood, it continues, we seem to be coming out of the pandemic. And as the entire world starts re-engaging and wanting to move about and travel, more energy is going to be required. I just read this morning that the big three airlines are saying that transatlantic air traffic will be back to 2019 levels by this summer. Let's hope they're right. But the point is, it's going to use a lot more energy. So I think it's that the confluence of greater demand with less supply being made available that could drive energy prices higher. Having said that, I think near term, you've got a little bit of an overbought situation where energy stocks year to date are up between 20 and 30%, far outpacing the nearest other sector. And of course, you have some special factors, including the geopolitical difficulties with Russia and Ukraine, which could, of course, disappear at any point. But, the irony is people want growth stocks, but if you look at the growth in earnings and cash flow projected over the next couple of years of these energy stocks, they far outpace many other traditional growth areas, including healthcare, even technology, consumer staples.
And when you say that you think some of these stocks are overbought, are you referring just to specific stocks? Or are you referring to, do you think the price of oil today is fundamentally above what it should be?
Yeah. So, I mean, if all of a sudden we saw the virtual handshake between Putin and Biden, and a real genuine dissipation of the tensions, I think that per barrel price of oil would drop 10, maybe even 20% before you finish your cup of coffee in the morning. And of course, energy stocks are going to follow. But that's the short term. And I don't, and ultimately I think that the drop in price would be overwhelmed by the continued growth in global economies, and of course that continuing transition where people are not getting the permits for further fossil fuel development. And indeed, of course, it's a perfect storm, because in most areas of the world they don't want to use nuclear fuel either, which is another alternative which could save the environment, but because of Fukushima in Japan is off limits for just about every country. And so you really have a shortage. And of course, a lot of the things that we think are going to help, and I'm sure they do help, for example, EVs, electric vehicles, you still need to generate the electricity. And most of the generating facilities run on natural gas. And so you're still going to have strong demand for fossil fuels, and it's going to take a long time before there's a genuine switchover, maybe 2030 or later.
Yeah, I think that makes a lot of sense, that thesis. And talking a little bit more about Russia, are you primarily viewing the tensions with Russia as a buying opportunity because of the fear and some equities getting bid down and becoming much cheaper? Or are you primarily viewing it as a threat?
Well, I think it goes short term or near term. There's no question about it. Stocks would be down if the news in the morning were that Russian troops actually invaded. But here's I think there's a couple reasons why longer term that would actually be a buying opportunity for people who have a longer term horizon. First of all, history. History shows that actually war tends to be good for economies and ultimately good for stocks. Of course, it always helps if you're the winner in the war than if you're the loser, if you go back to World War II. You think about it, people are making plans for this weekend. They may want to go out for a nice meal, whatever. Are they going to put those plans on ice because Putin has invaded Ukraine? I think the answer is no. They're still going to do what they're going to want to do. The other thing I think you have to realize is that at the end of the day, global trade is going to improve all the countries' economies that are involved with it. And ultimately, no matter where you are, whether you're in China or in Russia, United States, you want a better economy. And to the extent that cessation of trade is like a supply disruption, drives up prices, drives down the Russian currency and so forth, that's not going to make the people happy longer term. So I think at the end of the day, there's tremendous pressure on the part of governments and politicians to keep the global trade going, to be able to continue to sell their natural gas, if you talk about Russia, to Germany and the rest of Europe, for China to continue to export to the United States. And they don't want to stop that. They want to talk tough, but at the end of the day, it's really in everyone's best interest to keep that trade going. So a big sell-off, I think, can be an opportunity, because ultimately, I think the olive branch will come out.
Yeah, absolutely. That makes a lot of sense. And talking about China as well, how do you sort of view the future of the country economically and in terms of economic GDP growth? And are you at all concerned at the increasingly sort of stagnant population pyramid?
Yeah, great question. So basically, I think China could offer an excellent opportunity for investors. I mean, it has historically had a higher growth rate. And even though there are concerns about population growth, I think most experts think it's still going to grow faster than the United States. So you've got that fundamental growth going on. Second, of course, is stocks have sold off big time over there. And of course, they have concerns just like we do in terms of privacy, in terms of monopolistic tendencies and so forth. But at the end of the day, they need to keep their economy going. They need to be able to keep that real estate market going. They need to keep their financial markets going, because that's the only way they're going to keep the best and the brightest within the country. Otherwise, people just look to take their money out, and there'll be a huge brain drain. And of course, although Xi is considered the premier there as, I guess, a dictator with lifelong tenure, the fact of the matter is, if that country is perceived not to be well managed, well run, he's got to be watching his back. And everyone's got their phones and so forth, and they're looking at stock prices and looking at what's going on around the world. And if ultimately they feel she is a problem to economic development, he too will ultimately have to turn the keys over to someone else, notwithstanding it's not the same type of election system we have in this country. So I do think that China will grow well, and that it can particularly offer investment opportunity and a good way to diversify from generally fully priced US stocks.
And so how do you view, how do you understand the, let's say, political and policy risk in China? Like, for example, we saw with private education companies that all of a sudden their business model basically just got wiped out by new legislation. If you have investments in China, can you just talk a little bit about how you sort of understand that type of risk?
Yeah, so it is difficult, of course. And we have seen, some of those education companies fall 95% that are publicly traded here, and you have to be scratching your head. But two things I would say: I'm not advocating investing in those right now, but I think one of the theses is, at the end of the day, no matter what the government does, no matter what the policy is, every parent wants the best for their kids. And they're going to do what they realize the key to advancement is education. And to the extent that they feel that these companies have been delivering good value by giving their kids that extra educational boost that they're not finding in the schools otherwise available to them, they're going to figure out a way to do it. Obviously, they could try and send their kids to the United States, but it's probably a lot cheaper to enlist the help of an after-school, private educational company. And then, of course, often when people talk about what the fundamentals look like, but the fun thing about investing is you can't separate any discussion of the outlook without looking at the price of the investment. And when something is marked down by 95%, it's a little bit like buying a car that's kind of beat up and so forth. Is it the best car? Of course not. But if somebody's going to give it to you for $500, you'll take a chance on it and see if you can't get a couple more years out of it. So that's one thing I would say. At the end of the day, if they garnered a lot of consumer appeal before, they're likely to continue doing that. At the end of the day, often the politicians, they talk tough, but ultimately people get around the rules, and or the politicians pull back and allow these companies to do what they do best. And then, of course, it's all about diversification. So you've got, just like in this country, you've got your tech companies, you've got your energy companies, you've got your financial companies, as well as your education companies. You probably want to take a broad swath if you feel that ultimately China can get back on its feet here.
Yeah, absolutely. That makes a lot of sense. And let's switch to talking about some more domestic problems in the US. The NPV of Social Security and Medicare for the next 75 years is projected to exceed tax revenue by about $50 trillion. So how do you see this playing out in the long term?
Yeah, that's a great question. I think I'd probably separate Social Security from Medicare. Social Security, the beauty is you can really get your arms around what the costs are going to be, because you can look at the demographics, you can look at what the payout ratios are, and figure out what your costs are going to be. And by tweaking the amount of each paycheck that gets paid in there, in terms of garnering more revenues, or reducing somewhat the payout, if people are living longer. Right now, Social Security can start as early as age 62. If they just bump that up to 64 or 65, they can make the tweak so it becomes self-sustaining. So, and quite frankly, Social Security for most people is a much smaller piece of the retirement puzzle than it was 30 or 40 years ago. And so therefore, already by not growing it as much as overall retirements are require, they've made it a smaller piece of the puzzle. I think the Medicare is much more difficult because they're coming up with new treatments, new drugs, new ways to help people health-wise that how can you say no to, and you have no idea what they're going to cost. And to the extent, of course, that you allow people to live longer, those costs can go on for years and years and years. I think recently Biogen came out with a drug, and the cost is going to be like $70,000 a year. Well, if everyone needs that, how do you get your arms around what this whole system is going to cost? So I think that's tricky. Obviously, there are things that they can do, and they're threatening to do, price controls on prescription drugs, reimportation from overseas, maybe making a single payer instead of having private health insurance. Each of those solutions has, of course, negatives. If drug production becomes less profitable, guess what? You have less of it. If you have a single payer, does it become like the post office? Does it become like the IRS, where people get frustrated? There's no competition. So I think that is a tougher situation. But I guess what we try and do is, focus on the things we can control, not worry too much about what you can't control. And of course, I think an overriding theme for any investor is, to the extent the concern is out there in the public domain, you have to start with the proposition that's already been factored into stock prices. It's the stuff that's no one's talking about, that that white rhinoceros that comes out of nowhere that can really hit the stock market hard. But to the extent that we're talking of, for example, the Russian-Ukraine problem, inflation problem, the Fed hiking interest rates, arguably you have to start with the supposition that you don't have an edge by trading around it, because everyone else who you trade with knows about the same concerns.
Yeah, absolutely. And talking about some of those concerns, inflation recently has been very high historically. And, interest rates and, bonds still carry quite low interest rates. So do you think we're currently in a bond bubble?
I think most people think that we are in a bond bubble. Interest rates have been artificially depressed. And the key reason is, if you look at the Federal Reserve balance sheet, it's skyrocketed. So you've got a deep-pocketed buyer, which has basically unlimited resources to create fictional entries and buy bonds, have taken up their balance sheet up to about $9 trillion. That can't go on forever. We know that they're talking about not only stopping quantitative easing, but ultimately starting to taper the size of that balance sheet. And so that's going to drive interest rates up. We do know that inflation is a huge problem. We just got this morning the producer price index. It showed, I think it was 9% year over year. CPI was 7.5% year over year as delivered for January. And so it's a problem. But on the other hand, I think most people feel that inflation, like everything, is a bit cyclical here. And so that there are factors which are going to help bring inflation down. Now, what the terminal value is, we don't know, but we do know that a lot of prices have gone up because of supply chain disruption. We know that there's like 75 ships off the port of Los Angeles that can't deliver. That's driving prices up. We do know that there's probably 5 million people who could be in the workforce who, for whatever reason, are still not comfortable reporting for work. And so to the extent those people come in, that's going to take the edge off of wages, I believe. So, I mean, no one really believes that inflation is going to be 7.5% for the next 10 years. And the bond investors are silly because they're willing to accept just 2% per year interest for the next 10 years. Having said that, of course, I do think interest rates are likely to go up. I think the good news for an investor is that it makes cash less attractive. It makes locking in for fixed income less attractive. And historically, stocks have actually done well with a little inflation, because not only does it drive up the prices of goods and services, it also drives up profits. and that's good. The real problem, of course, comes when the Federal Reserve really gets serious about putting their foot down and not just taps on the brakes or takes their foot off the accelerator of money creation, but slams the brakes. And at that point, interest rates can go up suddenly very high, and all of a sudden, the music will stop. Consumers don't have the money to pay for those higher goods because things have gotten too expensive and interest rates have gone too high to buy homes and so forth, and then the economy can slip into a recession. But of course, the problem is we don't know when that's going to happen. That could be this summer, that could be 3 summers from now. And historically, even with those periods, investors still have been done well in the market.
Yeah, absolutely. And another sort of concern that some people have is since the great financial crisis, if you take, for example, the top 5 banks, the amount of financial assets they hold compared to before the financial crisis is significantly higher. Are you concerned about that at all, that if we have, another sort of financial crisis, it'll be even more serious?
I think the consensus is that anything is possible, but certainly loan quality is better than what we had back before the subprime crisis. There weren't the, liar loans, the no doc 100% loans for real estate at very inflated prices. So I think one thing you have going for you is better loan quality. I think another thing, of course, is there were reforms made in the wake of the subprime crisis so that now financial institutions by law must carry more reserves, more cash in the books relative to their loan balance, so they are less leveraged. Now, the problem, of course, is that makes them less profitable, but it does make them less risky. And of course, the other thing to keep in mind is that banks tend to do well in a rising rate environment because many of them now have floating rate loans on their books. So as rates go up, they should be able to reprice automatically the amount of their cash flows coming in. And it's unlikely that we're going to see deposit rates go up nearly as fast, partly because right now bank loans aren't a hot commodity right now. So there isn't that much demand. So I don't think banks are going to be raising rates paid out to deposit very quickly. Therefore, that net interest margin should start to move up. So banks may not be the problem child in the next downturn the way they were in the subprime crisis.
Absolutely, yeah, that makes a lot of sense. And we spoke about oil already. What other commodities or metals do you think have an attractive setup in the long term, or you think, let's say, demand will far outweigh supply?
Yeah, well, certainly with the expanding global economy as we come out of the pandemic, all commodities should be in demand. Remember, there's been very little exploration and development for commodities for the last decade. Mines have been closed in. Investors have not wanted to put their money in that area. They've been enamored with all things tech. And so the amount of available supplies is much lower than might be required. One thing to look at, of course, is that in the changeover, perhaps from conventional vehicles to electric vehicles, a number of commodities are going to be in greater demand. I think anything that goes into a car, aluminum, for example, will be in demand. Obviously, a lot of people are looking at lithium and the shortage of those supplies that are used in batteries. Unfortunately, a lot of those lithium stocks have gone to the moon already. So that's something to watch. I also think that potentially people could have opportunities in gold and silver. Maybe they are the tangible Bitcoins, but they have not had much play in at least a decade now. And the way I think investors should look at it is not necessarily to buy the commodity itself, but to look at some of the companies that are in that area. Their balance sheets are pristine. No one has any debt because no banks have wanted to lend to them for years now, and they've been told by their investors, don't invest for the future. Any extra pennies you have, distribute them to investors by buying back your stock or paying dividends. So they're trading at like single-digit P's with no debt. So there's just any kind of movement up in gold or silver prices, they could do well. Remember, I think the all-time high in silver price is about 50. You're at about 20. So to the extent people are saying everything is overpriced, that's not the case there. And even gold on an inflation-adjusted basis topped out at about 3,000. So that could go up too if there is some sort of disruption in the marketplace and stuff like that. Just something to look at.
Yeah, absolutely. That makes a lot of sense. And some questions here about how you use stock screeners. Do you use quantitative stock screeners? Do you use keyword screeners? And if so, how do you use each?
Quantitative, and what was the other type of stock screener?
Keyword screener. So like looking for keywords in filings, for example.
Yeah. So I love quantitative screeners because, I think the beauty of being quantitative oriented, being value oriented, is it allows you to quickly get past the story and the hype and the hoopla and get right down to the numbers. Instead of someone saying, oh, this is a great company, this is a great product. So, well, hold it. What will be the cash flows from this service, from this product? Compare that with your investment outlay and make a concrete decision as to what's best. Going back to that example I talked about, where when you're in that store, you look at the little sign, how many ounces of peanuts am I getting for my dollar? Planters versus the house brand. You can, and being very methodical and mechanical can help you stay grounded. So the beauty of the screeners is you can put in those metrics we've been talking about: cash flow, revenues, debt, profits, free cash flow, and go through a whole basket of stocks very quickly, and then get it down to 10, 15, 20, where you can really roll up your sleeves and try and understand the story and look at some factors that are harder to screen for. For example, market share, for example, size within their particular sector. And that can help you make some decisions. So they can be, the one I like is on fidelity.com, where we keep our accounts and so forth. Is certainly free if you have a Fidelity account, and you can have, there may be 100 different variables, and you can start thinking about which are the ones that could make a difference and start creating your own screen. And then when you come in each morning, you fire up your laptop or whatever, you can bring up that screen and it can show you how all these companies rank. For me, that's so much fun and such a great way to sift through the entire market. In terms of keywords, I don't know. Certainly, it's very, very important to stay up with the stories on your various companies. And so if you do see something that looks too good to be true or some sort of movement, certainly you want to be looking at what the latest news is to see if you can put it into perspective. Now, what I love is your favorite stock is down because someone else in the industry stubbed their toe and say, well, that's their problem. And to the extent someone's going to give me a couple bucks off of my potential target because of something that's really not central to what this company is doing, that can be an opportunity.
Yeah, absolutely. And what are some permanent changes in the economy that you see resulting from this pandemic, long term?
Yeah, great question. You got to think, I guess, that there's going to be maybe a little less business travel, a little more Zoom use. Certainly, we're all more productive to the extent that we can hop from meeting to meeting without getting in the car or getting on a plane and going there. So perhaps there's less business travel. On the other hand, of course, a lot of business travel wasn't necessarily because it was that productive, but it's kind of fun. People want to take that business trip to, Los Angeles and catch the Super Bowl at the same time. Have some nice meals at some fancy restaurants and places they haven't been. So I wouldn't overstate the amount that business travel won't come back. In the same way that tourists like to get out and do something different, I think business people like to get out from behind their desk too. So that's certainly one thing. Maybe there'll be continued, CVS and Walgreens drugstore chains have seen a tremendous surge in their business because people are going in there. And, maybe their businesses will continue to be strong. People will realize they don't want to do everything via mail or the internet because, when you need to get a test or something, you want to have a relationship with that store right down the street. And maybe people are reawakened to the beauty of having something right down the street. Perhaps, this will be a wind in the sails of drug companies and other healthcare companies because people will be less willing to try and tie their hands just to save costs because they realize the importance of having that private sector developing vaccines, running those trials, because it potentially could save us from the next pandemic. So it's really going to be interesting. Having said that, I do feel that over the long haul, one should be skeptical that the changes are going to be that great. And I'll give you a perfect example. 2001, 9/11. I had friends who said they would never get on an airplane again. They said they're a sitting target. The terrorists are going to destroy them. And, 5 or 6 years later, they're flying all around. So people say they'll never do certain things again. But if the price is low enough on what is being affected in the stock market, consider that as a potential opportunity.
Yeah, absolutely. That makes a lot of sense. And what qualities, backgrounds, and experiences are you looking for in college students who dream of interning at PPAC Gladstone?
I think you need a fundamental interest in the stock market and so forth, and have the patience to sift through a lot of numbers, sift through a lot of news and so forth. Probably a little bit of an independence of a thinker is important. Just because everyone says this, you want to say, hey, let me examine the facts myself. I'm not going to develop a herd mentality. I want to do my own thought process. Obviously, communication skills are critical. At the end of the day, you can be a great investor, but if you can't convince someone to give you some money to invest, you have nothing to do. So no matter what profession you're in, you need just a little bit of communications skills so that you can convince a person, whether it's your employer, whether it's a prospective client, or an existing client who wants to do something that doesn't make sense, to be able to communicate why what you're offering is the right course and get them to say, yeah, I'll give you the chance. I'll keep my money with you. I'll turn over my money. So certainly written and oral communication skills are always critical.
Yeah, absolutely. And throughout your career, what were some pivotal financial or economic events that changed the way you thought about investing?
It would have to be the dot-com crash. Certainly, back then, it was very difficult to be a value investor. Clients came in my office and said, I don't care whether you can beat this S&P 500, can you beat the NASDAQ? And of course, the NASDAQ was up 79%, and you knew that was just a disaster waiting to happen. And of course, the problem was that these companies had no earnings. They were being evaluated on, clicks on their website, on eyeballs watching their website and so forth, without any regard as to whether there's any long-term financial viability. And these stocks were going up, and people were saying, well, why aren't we in these stocks and so forth? And the temptation to just say, you want it, you can have it. It seems to be working, even though it's inconsistent with what value investors do. It's totally contrary to what Warren Buffett is doing. Indeed, people were calling Warren Buffett a dinosaur. His brand of approach of value investing was said to be out of touch. And then ultimately, it took years. I mean, even Arthur Greenspan, who was then the Fed chair, talked about irrational exuberance. But he said that, I think it was in 1996. It wasn't to the year 2000 that the wheels started to come off the bus in terms of the dot-coms and the growth stock craze. And then it took till like 2002 for the NASDAQ to be down 80% from its high point. So I think that's been the pivotal thing to see that, at some point, the growth stock where you are paying no attention to the fundamental cash flows or the financial value of what you're buying, and you're just chasing stocks because they're in vogue, will ultimately lead you to financial ruin. I think that's been the pivotal event that occurred during my financial career here, and I never forget those times when things you didn't understand what they did. And to bring it full throttle, back then I can remember the Super Bowl of the year 2000 when you had pets.com and all these .com stocks taking the money they had raised and throwing it into Super Bowl ads. And today, of course, what the echo is in the cryptos, when all these crypto companies, although crypto's been around 10 years, now they have so much market cap, they're throwing the money into the ads in the Super Bowl. It'll be interesting to see what happens.
Yeah, absolutely. And for a concluding question, are there any specific investment theses you want to discuss today?
So we still like, the value stocks, and that would include energy, that would include financials, that would include industrials and so forth, where we think that they've been out of favor for about 10 years. And if in fact this economy continues to come back, we think that since they have that cyclical twist to them, and because the valuations are lower, tilting in that area will continue to make sense. I think there's a lot of healthcare companies that could do well. I think there's a lot of people who are very concerned that the government will bring the hammer down on prescription drug prices. Just today, I was reading that the governor of my state, New Jersey here, wants to put price controls on prescription drugs. I think ultimately price controls don't work. I learned that in the 1970s when they tried to control the price of gasoline. And so to the extent that, valuations, you've got the Mercks and you got the Pfizers trading at 10 or 11 times earnings, but they're blue chips, industry leaders, dividends 3 to 4%, could do quite well over the next 10 years particularly if there's a change in government and the concerns over heavy-handed approach to healthcare legislation goes away. Those could be great investments as well.
Thank you so much for the session. It's truly been phenomenal, and we really appreciate you taking the time out of your busy schedule to speak with us today.
I've been honored. Thank you so much. Appreciate it.
Absolutely. Have a great day. Thanks.
Bye-bye.